Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated. And with a little bit of a look back on the previous week, Miles, why don't you jump right in with our summary of numbers?
Yeah, our weekly recap, so to speak, right? You're going to hear a running theme this week, fellas. The four-letter word of the week, it's an F word. It begins with flat, with gold staggeringly up $6 from our recording last week. We actually did have a little bit of a range on gold. It was up and down, about $30 up, $30 down at one point. But ultimately, we started the week at around like 1508. We're currently at 1508. So not too much there. And it doesn't get too much better as I go down the list here. Silver down a whopping 11 cents. And about the same, around a 2% range up or down from where we started. Platinum stepping up a little bit. It's all the way to down about 3% from where it started. So also a range about 2% up and down. Palladium down $5 whole with a slightly bigger range, a little bit more volatility in palladium at 3% up and down this week. And the S&P is just pancake flat, 21 points down this week. So not too much movement kind of across the board, up or down. And that's actually all on the heels on the dollar, which is dead flat, except the one thing the dollar did do this week that we'll look at the chart here in a second is the dollar did break slightly below those December bottom. So kind of the bottom end of the trading range that the dollar's been in for the last 6 or 8 months, came right in and an inch just below it this past week. Bounced back above, but we did have a little bit of a puncture there. So really quiet market, guys, following on the heels of quite a bit of activity over the last couple of weeks. What do you guys think's going on?
I loved your recap that you guys did last week on the U.S. dollar. That, to me, is still an area that we need to be watching closely. Talking about the rate cut, that's weak dollar policy you mentioned. Miles, you did bring up a key point on buy the rumors, sell the news kind of thing. Maybe gold actually does drop and the dollar pop when the rate cut occurs. I don't know, but they're talking about now, what, Rob, September and November, maybe September, November, and December from a rate cut standpoint. So we'll just have to see what they do. But that's weak dollar policy, which would drive it down below that support level.
For the dollar.
For the dollar, and then who knows where gold goes as a result of that.
Yeah, we could easily see 2750, easily.
On gold, 2,750.
Yep.
Yeah, I agree. I mean, that's just a steady move from here, and you guys also brought up the point that it's up 30% year over year, and so for that trend to continue, we don't see necessarily any interruption. I mean, most of that $6 climb happened just in the last couple of hours today as we record on Wednesday, so flat is the word. But BRICS also, they're meeting in October. We'll see what happens as far as the dollar and the world reserve currency, and that'll be another kind of chink in the armor in a sense.
And seasonality, and we're heading into the fall season, which is usually the strongest period for the metals besides the spring. The spring has superseded the fall markets, but you also have Indian wedding season kicking off. We did not have a very weak gold market this summer. So as we enter into the fall in the last quarter of the year, it's going to get interesting.
Remember, too, the government's fiscal year ends after
October.
September, right?
Yeah.
So we're in the fourth quarter, so the fourth quarter will end. And as that news starts to roll through, what are the final numbers as far as debt and, the federal debt? And
can we trust the numbers they're going to give us, or are they going to revise them like they did employment?
Yeah, great point. Here you were also talking about the Federal Reserve and the Jackson Hole meeting. I mean, they came out and said a whole lot of nothing, and they didn't even mention that jobs report.
Amazing.
They didn't even talk about the adjustments, which to me, that's where all of the justification's going to be.
Yeah.
Whether it's for a rate hold or a rate cut, you have to bring that up, and he didn't mention. So that's shocking to me.
Well, I mean, strong employment is inflationary. Weak employment weakens inflation according to their metric.
They just don't want it to go too fast. So a lot of people feel like they've already waited too long, that we're in a recession.
Yes.
And there are signs and symptoms left and right. We all feel it. You can listen to consumer spending. You can look at consumer sentiment. But you can even look at KFC mysteriously closing all these restaurants out of nowhere. When fast food chains start going down, then you know people are tightening their belts. But there's a SOM rule, and there's the inverted yield curve in terms of the treasuries. There's the M2 money supply drop. I mean, those are three very consistent, very stable predictors of recession that say we're already in a recession. So if they've overshot and they've slowed the labor markets too much, then they need to stimulate, and that's why they cut rates, right? It's all a stimulus.
Right.
So, Miles, if that in fact is something that happens and we get a rate cut and a dollar drop, I mean, sorry to have all the attention on the dollar, but support level wise, I mean, has anything changed for you and what you would see happen if your support doesn't hold on the dollar index?
Yeah, let's take a look at the dollar. Before we do that, though, I got to tell you from the cheap seats over here, I've spent the last 30 seconds trying to figure out how to spell SOM. So what's the SOM rule?
SAHM.
Give us a little Wikipedia.
Okay, you just put me on the spot.
Oh, yeah.
All right. So this is when the unemployment increases more than 0.5% when GDP goes down. So if the unemployment numbers spike in a 3-month period of time by 0.5% or more, it says that we're in a recession. And that's what has happened to our unemployment numbers, is that unemployment has spiked. And here's the thing, that's based on the pre-adjusted labor market numbers. Okay, so then they come in and they adjust everything even lower. We now know that the unemployment is a legitimate concern, that if there are too many people out of the workforce, and I'm telling you, I would tell every listener, go to debtclock.org and you can learn so much about what the real labor market numbers are, how many Americans are in the workforce and how many are not in the workforce. Rob, to your point, the numbers don't lie, but the people reporting the numbers lie in a sense, right? Or the formulas that go into the numbers determination are lies. So that's
the Bureau of Labor Statistics heavily cooks inflation numbers, employment numbers, productivity numbers. I know that for a fact.
That's right. So yeah, I hope that answers your question there, Miles. And there's about 3 others too that I won't get into for the sake of boring the listener. Just know that very strong, no fewer than 6 strong recessionary indicators right now. And that's why the Fed is going to be under a lot of pressure to cut, because if they wait too long and we deepen into a recession, 1, it's very politically sensitive with bad timing. But 2, that's their job. But they're famous for creating bubbles and bursting them. So getting back to the dollar, Miles.
Getting back to the not quite yet bursted bubble that is the US dollar. Yeah, I mentioned this during the little intro numbers there. The dollar, we've been looking at this trading range really with a low back in July of last year at like 99.6. You know, the subsequent high at like 107 and a quarter. But really, when we go back to when the interest rates started rising, or at least the anticipation of interest rates going up starting in 2021 and then ultimately starting February of 22, you're talking about the dollar going from like 90 all the way up to 115. We've kind of talked about this range for a while. We took 2 giant steps forward. We took 1 big leap backwards. And now we've been trading for 2 years pretty consistently. The dollar has been in a pretty healthy trading range between, let's say, 100 and 105. Most of the time spent. So for us to kind of see us put in a little, at least shorter term, lower price here, at least intraday, it's bouncing back up a little bit. I do think it's worth mentioning, but I wouldn't exactly consider that noteworthy. I think it's completely reasonable that we've been at the top of the range. Now we're kind of pushing down towards the bottom, and you could even see the dollar go back down to the lows sub 100. Which still wouldn't quite scare me. Now, what would scare me is if we get down, say, below 99.5, and we're getting out of this whole trading range. And that's making the assumption that interest rates are still up at 5 to 5.5. Because in September, if they lower interest rates, they ain't dropping interest rates 3%. They might drop it 25 basis points,
Right.
maybe 50. That's
Maybe.
a 1/4%,
Yeah.
maybe 0.5%, which would be
Maybe.
crazy. But now we'd be talking about going back to price levels where the interest rates were down at like 2. So significantly higher interest rates with a significantly lower US dollar. And Rob, this is part of what you and I talked about last week, is my big concern is once the honeymoon wears off of the US dollar has slightly higher interest rates. The US dollar has low interest rates instead of staggeringly, laughably low interest rates. 5% is still a pretty low interest rate if you look at history. 0% is laughable. So we've been in this weird sort of addictive phase for decades now, and the party's coming to an end and the hangover's about to kick in. And if we see the US dollar take a little bit of a decline here, it wouldn't surprise me at all. And it's unfortunate for the buying power of the dollar because it's going to be at significantly higher rates. That's less money people can borrow, and the inflation rate has jacked the price of goods and services up. It's no wonder to me that the biggest question I'm getting from people nowadays is, hey, what's going on with BRICS?
Yeah.
And what if BRICS goes to like some type of gold backing between all of their different currencies? And I'm like, well, that's the only way they'd ever trust each other. Like, how does China trust India? How does China trust Iran? How does Russia trust Brazil? Well, you do it with something that everybody trusts, something like gold. So I'm looking at the games that we're playing over here in the Western markets, and I'm thinking, man, China buys a lot of gold every year, and they dig almost as much out of the ground. No wonder people are looking for it.
Well, when you look at their trading partners, they can get raw materials from Brazil and from Saudi Arabia, even Russia or Iran, and that yuan is convertible into gold through the Shanghai Exchange, physical gold, not paper gold like what we see in New York and London. So there is already a de facto gold currency happening that puts China in the driver's seat.
That's why Russia is trading more through the yuan than any other currency now.
Right.
So that does make sense. And, Miles, you brought up kind of a less bad type of a scenario, and it's like the inflation. Not to beat a dead horse, but I mean, we can't trust numbers like you're saying, Rob. And just because CPI is coming down doesn't mean that we're good. And this was on X, that we've got to give full credit here, but you and I were laughing because comparing the CPI and trying to say that the CPI is good now and warrants a rate cut is laughable, right? Because that's like in 2020 gaining 5 pounds, 2021 gaining 11 pounds, 2022 gaining 9 more pounds, 2023 I gained 6 more pounds, and in 2024 because I've only gained 3 pounds, now I'm healthy, right? No, I'm not
Sounds like
healthy.
my last 6 months.
Yeah, that's right. I'm up 34 pounds. I'm less healthy, and that's our inflation numbers, and that's straining the economy. And talking again about just recession indicators, the Philly Fed report showed a 10-point drop in full-time hiring. That's the lowest level that we've seen other than the financial crisis and COVID. Don't tell me we're not in a recession, and don't tell me that they aren't going to need to stimulate. And Miles, all of your indicators are right. What does that look like at higher interest rates? And it's very concerning. And meanwhile, gold is the canary in the coal mine just singing the song that all of this is broken.
And it's holding steady. Yeah, we're holding steady.
It looks like probably some significant issues with, I would guess, the U.S. housing market and possibly, if not probably, the equities market as well, let alone what happens to the bond market.
Yeah, commercial real estate too.
Okay, yeah, absolutely.
Yeah.
Commercial
Yeah.
real estate.
The banking sector is still teetering on the edge. We now have had, like we said, over 500 branches closed in 2024. That's a major tightening of the belt. And now there's so many banks that are overexposed, over-leveraged, some far above 50%. And that doesn't bode well for the banking sector. So there's a lot that needs to change. You just don't hear a lot of talk about solutions coming out of Washington.
There's a category I always look at whenever we're checking bank ratings for clients, the non-performing loan category. That's the 90 days past due or worse. And if they defaulted, how would that affect the net capital of the company? So I've always considered that kind of a good indicator. It's basically saying, like, what percentage of bad loans are out there? Because no bank has 0 bad loans. 1 or 2% seems pretty reasonable. And a lot of these bank ratings I've been doing over the last 6 months, it's that banks that are heavy in that commercial lending and commercial real estate categories, they're looking at non-performing loans percentages at like 8, 9, 10%. And that's
huge.
That's scary to the banking industry. That's 10% of your money pretty much gone. It just hasn't been realized yet, just in one category of your investments. And this is in a real estate market that is still considered to be pretty strong. What happens when a crack or two starts showing?
Well, that's going to do it for Golden Rule Radio this week. Thank you for listening.
If you liked what you heard, thanks again for always clicking those YouTube buttons. It does help us out with the old algorithm. Better yet, why not head over to the thing that I will affectionately always call Twitter? You can find us at ICA Gold. We're also on Facebook at McIlvaney Financial. Better yet, hit up our website. We can be found at McIlvaney.com, and there's nothing more important than having a sit down with one of the advisors here at McIlvaney Precious Metals to discuss your personal portfolio. Give us a call at 800-525-9556. Thanks again. Appreciate you joining us. We hope you have a great week.